Alright, what is up, guys? We are back with another video. Day 3 of 3. We're going for 365 days. I do not care what it takes. If I have to, I will record videos in bulk. But today we're going to be showing you guys how to mark out key levels. Key levels are very important because this is basically levels in zones where it has very strong level of resistance and support. So when area gets to that price, it usually rejects. And so knowing this information, you can enter up higher probability trades. And so let me show you guys how to mark this area of interest out. Um, First and foremost, when you're marking out area of interest, you want to do a top-down analysis first because at the end of the day, higher time frames have more power. You know, that the weekly time frame, the monthly time frame. I don't usually go to monthly. Maybe just to check it out and look at it. But I usually don't use the monthly. I just use the weekly time frame. So I'm gonna show you guys now. We're gonna use this zone right here as an example to mark out our key zones on where we would buy, maybe possibly would sell. So right here, you could see that price came up to this area, but it rejected. It was a strong rejection. Right afterwards, there was a bearish engulfing. And what a bearish engulfing means is when the candlestick engulfs the previous candlestick. And when it's bearish, it means it's going down. So this red candlestick is a bearish engulfing candlestick. And you can see that it engulfs this entire blue candle before it. And so that's a very strong indicator that is a very strong rejection. And so if you go here to the right as well, you can see again same area. It wicked up to this area, and when you see these wicks, it basically means price was able to get to this point, but it wasn't able to close at this point. It closed down here. And so you can already see if you mark this area out right here. If I just put you can go right here, you can click on this plus button, you can just click draw horizontal line. That's what I like to do. So this is a very key level of resistance. And so let's look for a key level of support. If we go down here, we scroll down, you can see right here, the more you guys look at these markets, you guys are gonna be able to see this a lot easier. So for me, I just, I look at it and I see it. It's very simple. Like you can see right here, the area it rejected multiple times, 3 times to be exact. You draw another horizontal line. If you can see during inside these sessions right here, inside these key zones, area came up and then it got rejected very heavily. Came up again, got rejected very heavily, right back down to, guess what? It went straight down to the key zone of the key level of support from before that we marked out. Look how it rejected right here. It rejected right here. And look, after it hit the top, it went all the way down. It rejected back here. So look at that. Like just off of key zones alone and key levels, you guys already kind of know what direction the market's gonna head. Or you guys kind of have a higher percentage and higher probability of knowing what the direction the market's gonna head once it reaches these key levels, because it's a strong level of buyers or sellers. And so it hasn't been able to pass this point, and if it does, you want to wait for confirmation before taking any trades. But right here we have a key level of support down here, and we have a key level of resistance up here. And then these are key levels, but then you can also mark out other support and resistance zones inside of it as well, because obviously not just gonna be one or two levels of resistance and support. Otherwise trading would be way too easy. But these are the key levels. These are the big rejections. And so you want to, on the weekly time frame, you definitely want to mark this out. Now let's look for some more levels of support, resistance, and all of that. If you can see right here, this is also another level of resistance. Support. I'm sorry. Here, support, and this one is key levels. Key level. This key level resistance. Resistance is when you go up and you can't push through, and support is on the bottom, is supporting it up, and resisting is complete opposite. So this is another level of support and resistance. You guys can use this for support and resistance, because if you can see right here, the price came down, rejected, price came down, rejected, price came down, rejected right here during this week, this week, this week, this week. And then look, also you can also use these levels as support and resistance. So these are not key levels. These would just be support and resistance. And so you can see right here, this line, this middle line I drew. Um, there was a lot of rejections when it was going down, and it would reject back up. And when it was under the line, it would hit this and go back down. So look, it broke through this key this level of resistance slash support, and then it retested and went back down. Right here, you guys can see it was just it's kind of just consolidation right here, and it was heading back up towards the upside. It broke, retested, and then headed back to the upside. And so right here, you can see another rejection. And so the more you guys look at these markets, you guys will be able to see this a lot easier. But just based off of this alone, you can take a lot of trades. And this is basically the first step in taking trades right here. I marked out more key levels of resistance, and I call it area of interest, which is basically just high levels of support and resistance. And so it's the same thing. And so look how I marked these charts up on. I'll be showing you guys this later, but I marked this right here because this was a key level of support. And so every time price came down to this area, it rejected. So as you can see, this was also another level of that was being rejected heavily. Let me go to the daily time frame real quick to show you guys. So a lot going on here. These are the trades I took and everything. See, like I use these levels to take my trades. Because as you can see, it broke through this level, this key level of the area of interest, whatever you want to call it, and then it came back down to confirm to us that it's retesting and is rejecting it. So it confirmed that it broke through. It had enough buying momentum to break through this area of interest or key level zone that you placed, and then look at these rejections. It gave us rejections. 1, 2, 3, 4, 5, 6. 6 rejections. This used to be an area of resistance. Now it's an area of support. And so now I took this trade based off of this because after 2 rejections, after that I placed a trade right here with my stop loss 1 to 2. It was actually a 1 to 2.5, and I took the trade with a stop loss. Make sure your stop loss is always under your area of support, area of interest, your key levels, because that's when you know that, okay, this trade is not going the right way that I wanted it to. And so I placed down my stop loss below this, and as you can see, I placed my trade right here, and these 2 days it did go down to stop loss but never broke it. This day it did break it, but it's okay because the 3rd day I already took profit and it hit my TP right here. So I could care less what happens next because I already made my money. It doesn't matter. So right here you guys can see solid level of area of interest, key level, whatever you want to call it. Price was rejecting off of this zone. Right here. When it broke through, it retested. Look right here, another prime example. It broke through right here, the key level or the area of interest, and it came back up, which is the wick. The wick is what price was able to get to, but it didn't close here. So it tried coming back up, but it couldn't. So it went down. So it confirmed it broke through this area of interest. It confirmed to us, okay, we're heading down now because it rejected out of this area. And then this is when you go on to the lower time frame, because the thing is, you're looking at these charts right here. It breaks through this level and it's bearish, right? So it's a downwards momentum. The sellers are in, have the power. So in the lower time frame, it's bearish. What you want to do before entering a trade is you want to wait for it to go bullish, because usually it has to go bullish again to come back up to retest this level to confirm to us that, okay, now we're rejecting this area, and so we're going to continue down. So every time it breaks through a key level, it always comes back up to reject it. You guys have to remember that it always will come back up or come back down to reject that level again, just to confirm to you that the market is heading that direction. And so what I did was I would go, sorry guys, go to the 1 hour. Okay, right here. As you can see, it broke through, came back up, and retested. This is a 1 hour time frame, so it's a lot. Here, I'll switch to 30-minute for you guys to see. It's a lot. Right, give me a second, guys. Right here, the level that we came back up. You can see, actually no, sorry. It looks better on the 1 hour. Here you go. It looks a lot better on the 1 hour. If you guys go to this right here and you see it came down, broke this level, came back up. It tried going back through, but you see how these wicks right here, they're wicking. It's trying very hard to go back up, but it's confirming to us, okay, we broke through this level and we're going back down. So what you want to do is wait for that bearish momentum after it breaks the key level. You want to wait for this bullish momentum now, and then once it hits that area of interest again, since it was a key level of support before, now it's resistance. You want to wait for the shift of structure. So once it goes bullish, you want to let it go back up to retest that area, and you want to wait for a shift of structure for it to go for it to go bearish before you enter a trade. And so it might be sound a little bit confusing right now, but I'm gonna show you guys how to spot shift of structures in a different video. But just for today's video, I want to show you guys how to mark out key levels. It's very easy. You just need some time on the markets. You guys need to look at these charts on a daily basis and see how it moves. And it's very clear to see, like just this line alone, this line up here, like it's just areas that price tried to get to and break through, but it couldn't. And so every trader needs to know how to mark out key levels of support and resistance, all these area of interest. I think it's very important for a lot of these traders to start doing this. This is one of the first steps that you should be taking when marking up your charts for sure. And so I hope you guys really enjoyed this video, because it's just something very simple, but something that could, change the whole way you trade for sure. And so I'm gonna make more videos about how to enter trades based off of shift of structure. It might be a little bit too advanced right now, but I'm trying to make content for everybody. There's beginners, there's more advanced people, and there's intermediate traders. And so I'm trying to make videos for everybody as of right now. But this level is just kind of showing you guys how to mark out key levels and area of interest. And so I hope you guys enjoyed. If you guys want more examples or have any questions, leave it in the comments and I'll answer those questions. And yeah, you guys have a good day. Thank you for tuning in and watching this video. I appreciate it.